Let's talk about financial institutions. The objective of this section is to identify the services provided by banks and financial institutions for their business customers. Banking services can be divided into three broad categories: traditional services, electronic banking services, and international services. Traditional services include savings and checking accounts, loans, processing credit and debit card transactions, and providing professional advice. Savings accounts provide a safe place to store money and a very conservative means of investing. The usual passbook savings account earns between 0.1 and 0.5% in banks and savings and loan associations, and slightly more in credit unions. A business with excess cash it is willing to leave on deposit with a bank for a period of time can earn a higher interest rate by buying a certificate of deposit, or CD, a document stating that the bank will pay the depositor a guaranteed rate of interest on money left on deposit for a specified period of time. Business firms and individuals also deposit money in checking accounts so that they can write checks for purchases. A check is a written order for a bank or other financial institution to pay a stated dollar amount to the business or person indicated on the face of the check. Banks, savings and loan associations, credit unions, and other financial institutions provide short and long-term loans to businesses. Short-term loans must be repaid within 1 year or less. To help ensure that short-term money will be available when needed, many firms establish a line of credit, a loan that is approved before the money is actually needed. However, a firm may not be able to borrow money if the bank does not have sufficient funds available. For this reason, some firms prefer a revolving credit agreement, which is a guaranteed line of credit under which the bank guarantees that the money will be available when the borrower needs it. The bank charges a commitment fee ranging from 0.25 to 1% of the unused portion of the revolving credit agreement. The usual interest is charged for the portion that is borrowed. Long-term loans are repaid over a period of years. The average length is generally between 3 to 7 years, but sometimes as long as 15 to 20 years. Most lenders require some type of collateral for long-term loans. Collateral is real estate or property, such as stocks, bonds, equipment, or any other asset of value pledged as security for a loan. According to many financial experts, preparation is key when applying for a business loan. To begin the process, you should get to know potential lenders before requesting debt financing. The logical place to borrow money is where your business does its banking. You may also want to check your firm's credit rating with a national credit bureau such as D&B. Typically, business owners will be asked to fill out a loan application, and the lender will want to see your current business plan. Most lenders insist that you submit current financial statements that have been prepared by an independent certified public accountant. Next, compile a list of references that includes your suppliers, other lenders, or the professionals with whom you are associated. You may also be asked to discuss the loan request with a loan officer. If your loan request is not approved, try to determine why your loan was rejected and what you could do to improve your chances of getting a loan the next time you apply. A recent Gallup poll indicated that 76% of Americans have at least one credit card, and on average, Americans have 3.4 credit cards. Credit cards are important because when consumers don't have the cash to make a purchase, they can use credit. A merchant can convert credit card sales into cash by depositing charge slips in a bank or other financial institution. In return for processing the merchant's credit card transactions, the financial institution charges a fee. Typically, small independent businesses pay more than large stores or chains. Do not confuse debit cards with credit cards. A debit card electronically subtracts the amount of a customer's purchase from their bank account at the moment the purchase is made. When you use your credit card, the credit card company extends short-term financing, and you do not make payment until your next statement. Debit cards are used most commonly to obtain cash at automatic teller machines, or ATMs, and to purchase products or services from retailers. An electronic funds transfer, or EFT system, is a means of performing financial transactions through a computer terminal. The following 4 EFT applications are changing how banks help firms do business. ATMs are machines that provide almost any service a human teller can provide. Once the customer is properly identified, the machine dispenses cash from the customer's checking or savings account or makes a cash advance charged to a credit card. ATMs are located in bank parking lots, supermarkets, drugstores, and gas stations, and customers have access to them at all times of the day or night. However, there may be a fee for each transaction. Automated clearinghouses, or ACHs, process checks, recurring bill payments, Social Security benefits, and employee salaries. A point of sale, or POS terminal, is a computerized cash register located in a retail store and connected to a bank's computer. You begin the process by putting your bank credit card or debit card through a magnetic reader or chip reader. A central processing center notifies a computer at your bank that you want to make a purchase. The bank's computer immediately adds the amount to your account for a credit card transaction or deducts the amount of the purchase from your bank account if you used a debit card. The amount of your purchase is added to the store's account, the store is notified that the transaction is complete, and the cash register prints out your receipt. Electronic check conversion, or ECC, is a process used to convert information from a paper check into an electronic payment for merchandise, services, or bills. Bankers and business owners generally are pleased with EFT systems because they're fast and eliminate the costly processing of checks. However, some customers are reluctant to use online banking or EFT systems. Some simply do not like technology, whereas others fear that the computer will mix up their accounts. In 1978, Congress passed the Electronic Funds Transfer Act, which protects the customer in case the bank makes an error or the customer's credit or debit card is stolen. Depending on the needs of an international firm, a bank can help by providing a letter of credit or a banker's acceptance. A letter of credit is a legal document issued by a bank or other financial institution guaranteeing to pay a seller a stated amount for a specified period of time, usually 30 to 60 days. Certain conditions, such as delivery of merchandise, may be specified before payment is made. A banker's acceptance is a written order for a bank to pay a third party a stated amount of money on a specified date. No conditions are specified. It is simply an order to pay without any strings attached. Banks and other financial institutions provide for currency exchange. To make payment, you can use either currency, and if necessary, the bank will exchange one currency for the other to complete your transaction.